Bank of America files a document with the government every year, page after page of tables. On one of those tables, two lines sit almost on top of each other. Line 1. Money the bank parked at the Federal Reserve. What it earned, 5.05%. Line 2. Money you parked at the bank. What it paid, 2.72%. Same table, same year, same page. I did not calculate that gap. The bank printed both numbers and handed them to the regulator. But here is the part that surprised me, and it is not the part you are expecting. That 2.72 is an average, and the average is hiding something much stranger than a greedy bank. 3 questions. What the banks actually paid, where the gap really is, and why it did not used to be this big. Now the story you have heard goes like this. The Federal Reserve raised rates to 5%. The banks collected. You got nothing. The banks kept the difference. That story is wrong. And if I told it to you, the first comment would destroy me. Here is what JP Morgan Chase actually paid out in interest on deposits. 2021, $531 million. 2024, $49,559 million. That is 93 times more. The banks paid enormously. So if the money went out the door, why does it feel like it never reached you? Because of who it went to. This is the table that explains everything. It is in JP Morgan's own annual filing. United States deposits 2024. What the bank paid by type of account. Time deposits, a certificate of deposit, the kind you have to walk in and ask for, 4.93%. Savings accounts, the kind you already have, 1.39%. Non-interest bearing, the checking account, nothing. Same bank, same year, same central bank paying the same rate to all of it. 4.93 if you moved, 1.39 if you did not. The spread is not between the bank and you. The spread is between the person who moved their money and the person who did not. And the bank does not have to hide that. It publishes it. Why does that work? Because your money is what the industry calls sticky. And stickiness has a price, which the banks put in writing, in the same filings, when they describe deposits as a low-cost funding source. Look at the national numbers. America's Deposit Insurance Agency, the FDIC, publishes the average rate on a savings account across the entire country. In 2021, it was 0.06%. At its recent peak, 0.47. Today, 0.38. Now look at the number printed on the same page. The rate cap, 4.37%. Both numbers, same page, same regulator, same product. The average American savings account did not move, because it did not have to, because you did not move it. Now, at this point, someone always says the same thing. That is just banking. Banks borrow low and lend high. It has always worked this way. Has it? The British regulator asked exactly that question and went and measured it. Here is the Financial Conduct Authority in its review of the cash savings market. Quote, firms pass through only 28% of the base rate rise, compared to an average of 80% between 2004 and 2009. Rate that twice. Same country, same regulator, same product, 20 years apart. 80% used to reach the saver, then 28% did. So no, it has not always worked this way. Something changed, and the regulator noticed. One more number, for scale, and this one is audited. The Federal Reserve publishes its own financial statements. There is a line in them for interest paid to depository institutions and others, money paid to banks, simply for keeping reserves at the central bank. 2021, $5.3 billion. 2024, $186.5 billion. Careful with what that number means. It is not profit. It is not a gift. It is the mechanical result of a central bank raising rates while holding an enormous balance sheet. Some of it goes to institutions that are not even banks. But it is the size of the room the money is moving through, and the exit you take out of that room depends entirely on which account your money happened to be sitting in. So let me be precise, because precision is the only thing that separates this from a complaint. The bank is not stealing. It publishes every number I just showed you. The bank is not even unusually greedy. It paid $49 billion to depositors last year. The mechanic is simpler and colder than that. A bank prices your money based on how likely you are to move it. If you are the kind of person who moves, they pay you 4.93. If you are the kind of person who does not, they pay you 1.39. And they know which one you are. They can see it. They have your account. The rate you receive is not a fact about the economy. It is a measurement of your attention. And when attention does show up, the machine feels it immediately. March 2023, a bank in California, Silicon Valley Bank. One afternoon, a lot of its depositors paid attention at the same time. They moved their money, not over weeks, in hours. The bank did not survive the week. I am not telling you that to alarm you, and I am absolutely not telling you what to do with your money. That is not what this channel does. I am telling you because it is the proof. The whole structure, the low-cost funding, the sticky deposit, the 1.39 rests on one assumption, that you will not move. So, what did the banks actually pay? $49 billion at one bank alone. Where is the gap? Not between the bank and you. Between the depositor who moved and the depositor who did not. And why is it bigger than it used to be? Even the regulator could not fully explain that one. It only measured it. 80%, then 28%. The machine did not take your money. It priced your inertia. And it turns out inertia has a market rate. If the diagram helped, like it. That is the signal that puts it in front of the next person. And subscribe. YouTube will not show you the next one otherwise. One last thing. Everything in this episode was about a rate, a number the bank chooses and prints and can change. But there is another currency in your life that works exactly the same way. And you never think of it as money, your airline miles. Somebody prints them, somebody decides what they are worth, and somebody can make them worth less tomorrow without telling you. In 2020, 3 American airlines needed cash. So they went to the bond market and they put something up as collateral. Not their planes, your miles. And to borrow against them, they had to tell investors what the miles were actually worth. They wrote it down. That's next. Now, one bank could be an accident. So let me show you a second one. Wells Fargo. Same kind of document, same kind of table. In 2024, the rate Wells Fargo earned on the money it parked with other banks, 4.85%. The rate it paid on its savings accounts, 1.28%. And go back 3 years to when rates were on the floor. 2021, what it earned, 0.13%. What it paid on savings, 0.03. Look at what happened in between. When rates were near zero, the bank and the saver were in roughly the same place. Both got almost nothing. Then rates went up, and the bank's number went up by nearly 5 points. And the saver's number went up by 1.25. The gap did not exist before. It was created on the way up. And now, the part that I found the hardest to believe, because the bank writes it down itself. We have been talking about savings accounts, but most people keep most of their money somewhere else. The checking account, the account that pays nothing. Zero. Not a low rate, no rate. At Bank of America in 2024, the money sitting in those accounts came to $513 billion. $500 billion, earning the customer nothing at all. Now, you would expect a bank to be quiet about that. It is not. In the same table, where it reports what it pays you, Bank of America has a line with its own name and its own number. The line is called the impact of non-interest bearing sources. The bank calculated what the free money is worth to it, and then it published the answer. In 2024, that number was 0.94 percentage points of its margin. Read that again. The bank has a metric for how much it gains from money it pays nothing for. It has a name for it. It puts it in the annual report. This is not a secret. It is a line item.